How would you have fared if you invested just before a giant market crash? Here are some of the most iconic crashes throughout the last 100 years. The Great Depression, September 1929, the market crashed over 86%. 8 years later, it crashed 55%. Dot-com crash, March 2000, took the market down also almost 50%. Great financial crisis, 2007, took the market down almost 57%. 1973 was the oil embargo, stagflation, markets down 48%. Let's take a look at the first one, Great Depression. 10 years after the Great Depression, markets were still down 40%, but after 20 years, markets were up over 45%. That's without investing another dime. If you invested throughout the downturn, lowering your average cost basis, you would arguably do much better. After 3 decades, you would be up 850%. If we look at dot-com, March 2000, down 49%. After 10 years, you'd still be down 3%. That was known as the lost decade, where basically the returns were flat. 20 years later, though, you would be up over 219%. Looking at the oil embargo, January 1973, markets were down almost half. After 10 years, up over 90%. 20 years, 756%. 30 years, almost 2,000%. Time in the market beats timing the market. And again, that assumes that they withstood the crash and invested nothing else. If you actually lowered your cost basis by buying strategically and opportunistically, your returns would be a lot better. However, having said that, this is an example of sequence risk where if you retire and the markets crash, you need to have a long time horizon in order to recoup your losses. You can shorten that time horizon if you actually had liquid funds in order to deploy at the lower prices. But if you're always fully invested, then you just gotta sit and wait. Learn the lessons about money that your friends and family don't know. Download my free newsletter linked off the bio. Good luck, take care.